Welcome everyone to our Multifamily Investor Nation webinar. I'm your host today, Rob Gallo. I'm the Director of Investor Relations at PassiveInvesting.com. Whitney is currently at a conference for us, so she is doing her thing. And in fact, I think she's speaking. She's at Bigger Pockets this week. So good luck to her on all of those pieces. She will be back next week with a topic that I will share here towards the end of the call. But let's focus on today. So really wanted to spend today really talking about, the Federal Reserve cuts on interest rates. Really what's happening to your multifamily deal when that occurs. So we've been receiving a lot of questions about our multifamily assets from our investors in terms of what's the impact to the actual current multifamily deals we have, as well as what is the impact for multifamily deals that we're going to be looking at to actually purchase. So we'll go through some items here as we continue to talk through this webinar in terms of what those are. So let me kick in. So the agenda today, we'll do a quick introduction of myself, kind of my background, and then we'll talk about, the Federal Reserve in terms of kind of some of its mandates. And I think interestingly enough, if you actually look at really the mandates and kind of some of their targets, it's interesting to see exactly what current let's say unemployment and what interest rates are right now, or really it's more the effect of inflation, where it is currently and what the actual targets are. So I think that's kind of an interesting piece for everyone to understand. Then we'll go through kind of the impacts to a multifamily asset. I have a list of a few of these that I want to go through. Some of them have short-term impacts, some of them have long-term impacts, and some of them have both, depending on how these deals are set up. So we'll talk a little bit about kind of what those pieces are. And unfortunately, I wish I could give everyone a silver bullet here to say like, well, this is multifamily and therefore this is exactly what happens. But as everyone knows, the multifamilies are located in so many different places, so many different classes, so many different cap rates and all of those pieces, that a lot of that is going to depend on exactly that specific asset. But we'll get into a little bit of kind of those things that you might want to at least use as principles when looking through some of those deals or your current deals that you have with an operator. We'll talk about what's next in terms of, what we're hearing in terms of some of the Federal Reserve stuff. I'm sure everyone here is following their own news channel or indices to talk about really what's going on forward. I'm going to kind of stick it at a high level in terms of what we're hearing. You'll see some references to the Wall Street Journal on here. So you can definitely let me know if you want those links and what I've been reading kind of on a daily basis. And then we'll take time to answer some questions as we go through this. So who am I? Well, as I said, my name is Rob Gallo. I'm the Director of Investor Relations. Previously, before I joined PassiveInvesting.com, I was a consultant for 18 years. So I was definitely a person that, worked very hard in consulting. I've been at a few firms themselves and finished really my career as a partner at a small boutique firm. Along that time, I had always been interested in real estate, had been an investor in real estate, and specifically, a passive investor. I own a few Airbnbs with my family, kind of in the Michigan area along the Lake Michigan itself. I myself am located in Chicago. But then I got into passive investing, and actually with Danny Randazzo, who is, as some of you know, one of our founding members of PassiveInvesting.com. And I've been a passive investor with PassiveInvesting.com and a couple other firms for around 12 years now, actually, as I kind of reflect back on that. I made the switch into PassiveInvesting.com because I think my consulting career, I really kind of achieved everything that I wanted to there, and I wanted to be more ingrained into the really real estate investing, and a great opportunity arose, and I joined the passive investing team as the director of investor relations. Just, so you're aware, I've always read the Wall Street Journal. I went back and got my MBA at University of Chicago. So, I still am included with a lot of my friends that like to opine on the economy and everything, and read whatever else is coming out of the University of Chicago. So I'll try to keep any Milton Friedman isms from this conversation, but just so you know, that's kind of my background and where it all is. One other thing I will add here is that I am not a financial planner. I am not a CPA. I cannot provide you with advice on taxes and things like that. So if you do have any questions, seek out that professional that you know, like, and trust, and make sure that you get it from them. Okay, let's kick in. So, one of the key things that I do want to make sure that is shared with everyone is really what the Federal Reserve's, two main mandates are. And when it comes down to it, a lot of people say, well, the Fed just controls interest rates. Well, really, that's a tool that the Fed uses in order to basically secure their two mandates. And the mandates are, first one is full employment. The Federal Reserve basically has written in their charter that they want to maximize employment in the US economy. The second mandate that they balance is a 2% inflation rate. So I just put some of those current numbers up on the screen here. Current unemployment is about 4.1% right now. You could definitely go to more decimal places as you want. And current inflation rate is 2.5%. Now, we all know that there are headwinds, and specifically in inflation, we're coming off a tremendous inflation period in U.S. history, probably. Well, let's say the modern era, the second highest inflation that we've seen, since the 1950s in this area. So, for a lot of people or new time investors, this is really an unprecedented experience for them, not having lived through, let's say, some of the 70s and early 80s in terms of what inflation looked like there. But it's really good news that obviously we're seeing inflation, dropping and really having what seems to be trending back to that 2% inflation rate. Now, I don't want to get into a conversation about core inflation versus, non-core inflation, or really what that's doing. This is really just more stating kind of, hey, where is inflation right now? So the Fed is still focused a little bit on getting back to inflation at 2%. Now, the counter mandate, obviously, is current unemployment. And the interesting things about employment is that it's not necessarily a specific numerical target, because in reality, if you picked 4% as your numerical target, which, by the way, it's kind of what the numerical target is right now, that can change, right? Because in reality, even calculating unemployment is a tricky game that there's lots of sides to, in terms of, well, people want to work, but they're not in the labor looking for work kind of thing. And so there's a lot of, shades of gray that, is talked about of unemployment. But that's kind of the main piece that the Fed has been focusing on, since, they feel like inflation's trending in the right way. They really feel like it's the maximum employment that they're more concerned about. And so recently, as everyone I'm sure is aware on this phone call or on this webinar, is that the federal funds rate was reduced by 50 basis points at the September FOMC meeting. I think some of the pieces in there that people were expecting just 25 basis points of a decrease, but they kind of really pulled out all the stops to go to the 50 basis points. So one other key point I wanted to point out here is that the federal funds rate, just so people understand, that is the tool that they use. That is actually the rate that the Fed charges banks. So when banks actually need to make loans and they don't have enough cash necessarily on their balance sheets, they go to the Federal Reserve and take loans from the Federal Reserve to then actually let people borrow money from them. And those would be businesses or individuals, and what that is. And, generally, just from kind of where let's say the Fed actually changes the rate to when it's, let's say, feeling a majority of the impact or full impact, that's kind of agreed to be around 6 to 9 months of the impact is felt in the economy after that rate actually has been changed. So there is a bit of a lag in terms of what that looks like. So when we talk about short term versus long term, make sure that, when you're thinking about this, you could even think about that 6 to 9 months as kind of in that short-term period, maybe in that midterm period, where the long term is really coming out, it's for several years in terms of what that is. So again, not necessarily a hard set rule, what's short-term versus long-term, but it really starts to identify when you get into some of the specifics of the impacts that these changes have. So with that said, I wanted to move on to really what are those impacts. Now, I'm going to provide you a list here. I'm going to give you some color. I'd love to hear some questions or maybe even comments come in on the webinar chat just to kind of see what you're all thinking about that. But I'll give you kind of some of our thinking that we have at passiveinvesting.com, how that impacts not only new multifamily assets, but specifically on current deals, because I think there's a big focus on, hey, my multifamily might have been underwater, and I kept on hearing from my operator, it's interest rates. Okay, what about those interest rates, and what actually is going to be that impact? So let's look at a couple of these items here and kind of get into more of the specifics of what those impacts would be. So the first item that we have on here is lower financing costs. So, Fed funds rate comes down. Basically, people are borrowing at lower rates. Great. Lower financing costs. That's great. Well, in reality, there's a couple things here. So you could look at this on, let's say, a short-term impact, because if someone goes to buy a new asset right now, they're going to get a better deal on interest rates than if someone went to actually go and buy a new asset, let's say December of last year, right? So from a short-term perspective, there's a pretty immediate change that when an investor is looking to finance a property and acquiring a new property, that's going to have lower interest rates and potentially lead to higher returns on the investments. So that not only helps with those pieces, but also helps with certain loans that a property has in place. So if the property today is currently owned, and let's say you're an investor in that, it does have impacts on there. So let's talk about floating rate loans, fixed rate loans. So first and foremost, let me get fixed rate out of the way. It's not going to have a big impact on fixed rate loans. That loan is in place, it's fixed, not necessarily a short term, midterm, maybe a long term, depending on refinance. But in reality, the big change here is going to be on any floating rate loans that are out there. So you are going to see a decrease in your monthly debt service in the short term on floating rate loans. Now, that in itself is true if there's a floating rate loan with no cap rate. So this is someone coming in, creating a floating rate loan, and usually these are based off of prime and more recently SOFR. So it's SOFR plus some type of spread. I think on some of our assets, we're SOFR plus 2.5 up to 3.5, depending on what the deal is. And that's really putting basically those interest rates, real interest rates, in that 7.5 to 8.5 range that people are having to pay for debt. So if you have a specific property that has only a true floating rate loan with no interest rate caps on it, you are going to see that debt service decrease. Now, in a lot of cases, when an asset has a floating rate loan, you also have to have an interest rate cap. In fact, there's some lenders out there, when they did loans, when loans were at 0% or 1.2%, it was crazy in the early 2020s and late 2010s. A lot of the banks said, okay, we're going to give you a floating rate loan, but we're going to require you to pay an interest rate cap. And basically what that is that you provide them amount of money. So let's say it's $100,000. That basically is a hedge to cap that interest rate at, let's say, like 5.5%. And the bank basically is making a bet to say, well, if I cap this rate at 5.5%, and if you go above 5.5%, I'm going to pay you basically the difference between what the real rate is at the time and what the cap is. Where that gets banks into trouble, and what really happened, as interest rates actually started to skyrocket a few years ago, is that they were on the losing side of that bet, right? So it would cost $100,000 to actually purchase that interest rate cap. That's what they would charge to the operator. But the amounts that they started paying out when real rates got to 8% and even 9% was way over that $100,000 that they actually took, right? So how the bank actually does that, compensates for that, is that when that interest rate cap is up again, and usually they start off with a 2-year or a 3-year interest rate cap, to buy that next interest rate cap, it's far more expensive, because now they're saying, okay, well, we're paying out basically at 9%. So we're covering a spread of 4% on this interest rate. We believe that the interest rate over the next 6 months, year, or 2 years, or whatever that interest rate cap is going to be, they think that the interest is going to go, maybe a little bit up or stay steady. So therefore, they price that next interest rate cap to do that. And so that's kind of how they make up the money on those scenarios. Now, I know I just said a lot about this and lowering finance costs and the interest rate caps and things like that. The other impact that lowering the financing costs on this is that as interest rates start to come down and creep down a little bit, the banks themselves say, well, it looks like we're projecting to see these interest rates come down, so that when an operator goes to buy a new interest rate cap, maybe they're not as expensive as they once were, because in reality, they're still trying to incentivize that operator to buy the interest rate cap, to have that in place, but also not blow them out of the water to where they say, you know what, I'm going to switch loans. I'm not going to take an interest rate cap, and I'm just going to completely ride this floating rate loan down to as far as it can go. So in that case, you see some short-term impacts in terms of borrowing costs coming down, but you also see some longer-term impacts that if it's a floating rate loan that has an interest rate cap, it tends to get a little bit more complicated in terms of what the bank themselves, or the provider of that rate cap, is going to do, of what they think the interest rates are going to be over the next 6 to 12 months or even a couple of years. And that's where kind of that short-term to long-term plays out on the lowering of those financing costs. So I know I said a lot right there, but let's move on to the next one. It's a little more straightforward in terms of what we're talking about. So the next one that, is kind of a no-brainer here is increased property value. So this is relatively simplistic as well. Think about this, as rates become lower, that's typically going to enhance the buyer demand, right? Because money becomes cheaper. More investors are willing to purchase more properties because now they actually have, let's say, more cash, and the cost of capital is not as much. So that drives up the demand, which drives up the property values. Now, this is more of a medium to longer term play here. It's not necessarily that much of a short term, as we kind of mentioned before. This is really going to allow the interest rates to kind of take effect and impact the economy, and allow people to see that they have more cash available, that money is more cheaper. So you'll start to see these property values really increase in kind of starting that 6 to 9 months after the interest rates see a change. And if it's anything kind of what we're facing right now, you might see some trickle on effect as we continue to go. Unfortunately, the multifamily industry is not like the stock market, where all known information is priced into that dollar at the time. It takes some time for these things to kind of work them through across the valuations, because several other things need to happen. So that one's still more of a mid to long-term impact. The next piece is enhanced cash flows. So kind of coming back to, with reduced financing and even kind of what you're paying, you can see some of these lower mortgage payments come through, because of it's a floating rate interest a floating rate loan that you might have without an interest rate cap. And so you are going to see some of those mortgage payments actually decrease. You will start to see this change in floating rate loans with interest rate caps, but only after several actually cuts to the interest rates, because it's going to take it quite some time to work from that 8.5 that it is to come down to, let's say, that 5.5 where the interest rate cap is sitting. So you won't really necessarily see a change on those types of loans with interest rate caps until it actually hits that hurdle. And then you're going to see some of those lower mortgage outputs on that. The other piece that you see on this is obviously, you are going to see some improved NOI. That's going to improve the cash flow. And in reality, that's going to either help cover more operating expenses or capital needs for the asset, or even restart distributions if they were paused on those. So those can have more of a, can be immediate impact, but then kind of restart into more of the midterm in terms of our timeline here. The next one that I wanted to call out is the greater investor activity. So again, similar to those increased property values, as rates lower, oftentimes that's actually going to attract more investors to the multifamily market, right? That capital is going to be a lot cheaper to buy, and that multifamily market investors are going to want to get into, be like, hey, I can now afford this building that I think is such a great deal. I just couldn't afford the actual debt on it. Well, that's going to increase competition and potentially, leading to either quicker sales or higher prices. But it's really going to start to build that momentum, not necessarily in the short term, but more in that mid to long term impact. So you're going to start to see these start to kind of kick across, a little bit. I think we've seen some more activity, even with the Fed cutting just 50 basis points, but you're not really going to see it hit its stride until that 6 to 9 month period, which also is going to build on any other interest rate cuts that actually come after the 50 basis points that happened in September. So be on the lookout for some greater investor activity in the multifamily space as we do that. Now, the next one is kind of a one that's a little bit more elusive, but people talk about it all the time if you're talking about real estate, and that's cap rates. So what we see here is that as interest rates decline, you're going to start to see the cap rate, which is really the ratio of the property's net operating income to its purchase price, or the valuation of the asset. And what's going to happen is that cap rate itself is going to compress. So if you hear things like, oh, the cap rate's at 6 right now, or the cap rate's at 7, the operator who holds that asset wants that cap rate to come down, right? So the value of the property goes up, right? So I think even in some of the markets that we've been seeing, that we have assets in, we've seen cap rates in the range between 5.5 and 6 come down to 5 and 5.5. And the really only way to prove that, those cap rates, by the way, is really on what are the sales that are occurring in the actual community. You can do all you want with a broker opinion of value, but until that asset sells and it's inked on the dotted line, that broker opinion value and what that cap rate might be is really kind of just out there. Until it's actually signed, that's where you get your true cap rates, and that's where you start to see kind of the fluctuation. So as we see this is going to be a little bit of a midterm to longer term impact on the true valuation on these assets. And so that's kind of where you'll see that 6 to 9 months plus on our timeline that the cap rate compression is going to be. Now we're starting to move into some longer term pieces here. So we've talked about, the financing costs, improved property values, the cap rate compression, greater investor activity. Let's talk about improved tenant demand. So this is going to be a longer term impact. But as basically, you can figure that as interest rates become lower, that's going to help stimulate the economy, right? So there's basically cheaper cash coming in, more loans are going to be made, And this one kind of leads out into almost like an economics equation if you're into those pieces. But when you stimulate that economy, that leads to potentially higher job growth, and in reality, higher demand for rental units. And so as you start to see, these interest rates come down, it's really meant to stimulate the economy, job growth. And really, kind of the long-term impact of that is it can enhance your occupancy rates as well as increase in your rental income. Now, I want to caveat this one because the economy is never in a vacuum. And the economics, equation that I was just kind of talking about, that's a lot of things in economics are done in vacuums. And so there's going to be other, obviously, impacts on this. There's a lot of exogenous impacts in terms of what's going on. I mean, obviously the hurricanes that are impacting us right now, as well as other things. So this isn't necessarily completely tried and true, but in theory, there's a good way to actually prove that out. The next piece, again, is another long-term, and in the name, it's long-term, but it's long-term stability. So for existing property owners, lower rates can provide opportunities to actually stay in those assets. So it allows them actually more opportunities to refinance into new debt with better terms, which then helps actually improve the financial stability and potentially freeing up some capital for other investments on that asset or other things. So you can look at this as someone got into a multifamily, let's say with a floating rate interest rate loan. And, as interest rates start to come down, and they basically are experiencing that high interest rate environment, but as things start to come down, they're going to start to look at possibly doing a refinance into fixed rate debt that's going to keep things a little more stable. Now, there's a lot of other things that go along with those refinances. I mean, you still have to hit debt covenants. You still have to probably, if you're looking at a Fannie or Freddie loan, you have to be at 1.25 DSCR, as well as making sure that you're above the 85% in the occupancy. But really, this is going to help lead to a long-term stability of these pieces. So I'm going to pause there, see if we have any questions that have come up. Let's see here. We did get one. Regarding full employment, what is the unemployment rate target? Great question. I'm going to lead into this next slide for that question. So when you look at any of these articles that are out here, and actually let me go through this slide and then we can specifically talk about this. So the Federal Reserve has really two more meetings this year. It's November and December. Mandate number one that we talked about, which is bring inflation to 2%. So currently, again, like we said, inflation's around 2.5. I think even I've seen 2.51 or wherever that's going to be. But the Fed seems to be pretty locked in that the momentum of where they're seeing the inflation and really kind of the consequences of having the high interest rates that we had, that is continuing to drive inflation down to more of the target rate of 2%. So the Fed isn't as interested in, managing that as closely, because we've just gone through basically an entire inflation driven, federal funds rate increases. Now, it's really mandate number two, and this goes directly to your question, to achieve maximum employment. So I pulled this definition because I wanted to share how, in reality, it's not necessarily just a one size fits all here, but the definition that I pull is the highest level of employment or lowest level of unemployment that the economy can sustain while managing a stable inflation rate. So you can see that these, even in the definition itself, it's intertwined and allows the Federal Reserve basically to not necessarily just stick to one specific thing, but measure inflation, see where basically the momentum of inflation is going, and therefore then be able to say, okay, well, if employment's here, is inflation impacting employment, or are we seeing any wage growth, or in accelerated wage growth, or is it a very low wage growth, or just stagnant wage growth? So they're looking at all of these pieces in there while they're trying to manage inflation at the same time. So a couple of the articles that I read is that right now the target inflation is, or excuse me, target maximum employment is around 4%. You're never going to get down to zero because you always want some velocity in there, as well as measuring unemployment. And again, you could spend a whole webinar on just understanding what the definition of unemployment is. That tends to change quite a lot. And so that's why there's a lot of focus on, the month-to-month employment numbers. I think last month we were up probably even, 125,000 more jobs than actually were anticipated. But I think in terms of what I've been reading, that's not going to impact specifically what the Fed is going to be doing in November. And I think this last, and actually an article I wrote, excuse me, not wrote, but I read yesterday, is that it's still thought that the Fed is going to have more cuts of 25 basis points in each November and December. Obviously, new data that comes out is going to change that. But that is kind of what the thinking is at this point. So I hope you found today's topic insightful. I'm going to pause for questions here and just open it up to folks to write in any additional questions that they have on this topic. Okay. Not much coming in. But I do want to make a plug real quick for next week, our Multifamily Investor Nation. Whitney will be back, and next week's topic will be peace of mind for passive investors, building your I love you plan in emergency folder. So that one will be more specifically focused on learning how to create an essential, she calls it I love you plan, tailored for passive real estate investors, ensuring really that your family's financial security is completely set up with seamless management of your investments, and really understanding, let's say if unfortunately, something happens to you as the investor and you really need to look out for your family. What is that comprehensive strategy that really is going to protect your wealth and make it easy for loved ones to, follow through on those investments? So tune in next week for that specific thing. Since we don't have any additional questions, one other thing here. Are current multifamilies investments in trouble to 2025? What is the thinking in the industry? So yes, so great question. And I think, there's a lot of a lot of phrases like survive till 25, things like that on those pieces. But in reality, it's all going to matter specifically on the specific asset itself. That's where, if you go and you read a lot of either commercial real estate or CRE updates of the market, or even just generally multifamily in the market, you're going to see some probably pretty bad news. But honestly, we have assets that aren't necessarily doing so well and they're in great markets, but we also have assets that are crushing it and they're not in necessarily traditional, boomtown markets. I think what we're really seeing and kind of how you want to measure this against is understanding where that market is, what the competition is doing, if there's new assets that are coming online that are actually compressing either the occupancy or the rents of current multifamilies, and understanding that. I think overall, excuse me, so I saw another question come in. Overall, it's going to depend specifically on that specific multifamily in terms of exactly where it is in that market, what the loan is on that specific, what it's doing for competition, because that's really going to drive basically the distributions themselves or even the valuations as you continue to move forward. I can tell you there's some assets that, I've looked at recently and, looks like great loan, new asset coming on, good terms. But there's a lot of competition coming online at the, about 6 months out. And that's just going to hammer occupancy, and it's going to hammer any of the rent growth that is forecasted in that. So please pay attention to that when you're looking at pieces. All right, I mentioned BOV sit on the shelf until the asset sells. Okay, good question. And yes, assets are required to get appraisals during the year from the banks themselves to make sure that the loan is actually, meeting DSCR, so on and so forth. What I was specifically talking about there was actually the rate cap. So yes, can you decipher what, a cap rate's going to be based on some of those BOVs? Yes, but that truly is still an estimate. What really matters is when you're actually doing and measuring those um, cap rates, that's based off of the value of an asset that has sold, not necessarily what the bank thinks it is. Because in reality, in some cases, you're not going to get what the valuation is from an operator or from a bank in terms of that. And really the true aspect of that is going to be what the actual selling price is of an asset versus NOI. We have one other question. Why would an operator continue buying a new cap given rates are coming down? Great question. In some cases, the loans that they have with the bank requires them to have a rate cap that can be mandated by the bank. And if they don't do that, then they fall into default on the loan, or at least they haven't necessarily agreed to, they're not living by the standards of the loan. The other piece is that the rate cap itself, if let's say it is a high real interest rate, so for example the rates are capped at 5.6% and the real interest that's being paid out is 8.5, you basically have to do the math between what you think is going to happen with interest rates, right, over the next 6 to 12 months, and that's kind of where the typical extensions are, and measure that against what you would actually pay out for that real interest rate versus actually paying for a rate cap and locking that in to continue that 5.6%. So it's really a math equation depending on that, but still with not specifically knowing where rates are going to end up after one of the Fed's, cuts, as you will, from that perspective. All right. I think those are all of the questions that we have. I wanted to thank everyone for joining us today. And again, tune in next week as Whitney will be back and providing a lot of her expertise on these topics. Thank you, everyone. Have a great day.